Okay, we are live. Thank you for joining in this session. Let's begin. Welcome to Alphachain's weekly market analysis. It is the 13th of June. And we're starting another week, and the week has already started in the negative, following on from last week's Thursday and Friday session. I'll highlight more about that in a minute or so. But the key theme for me today is, are central banks, have they lost grip on inflation? And are now markets crashing as participants price in aggressive rate path stance ahead of us? Right, that is what's being discussed in the last few sessions that I've had with individuals, as well as what we're seeing in the market. Right, so there's this little image that I have there. You can see the bull market, the bull participants, sort of heading down the roller coaster. You got Jerome Powell and Christine Lagarde as two sort of prominent central bankers from last week and the week ahead. That's going to be in focus, mostly with the Fed. The Fed is going to be in focus. But okay, so coming over to, what are the key themes that I'm going to discuss today? Okay, so I'm going to put it down to 5 key areas. Okay, 5 key areas. The first is, let's start with the European Central Bank, Christine Lagarde, as you can see from the image there on the left. So the ECB are beginning to pivot to a more hawkish stance, and that came through on Thursday's meeting. And they're signaling a rate rise, a rate hike in July, and maybe a more aggressive rate hike than anticipated thereafter. Okay, so we're looking at a 25 basis point rate hike and then a 50 basis point rate hike thereafter. Now, this announcement that came in line with the end of their quantitative easing program that they've had in place, in addition to their asset purchase program as well. Okay, so all QE measures are being reduced and removed. In addition to, now we're looking at stimulus, right? We're looking at sort of rate hikes being put into place. Not stimulus, but rate hikes being put into place. So stimulus is being removed, rate hikes is forecasted. And we're talking about a central bank who has maintained flat or negative interest rates for a number of years, Okay, just admit someone to the room. Yeah, so that's the sort of one of the key themes to discuss for the day ahead. Most of that was already been discussed in that blurb. Okay, now the second most pivotal point from last week's session was, of course, Friday. Friday we had inflation data. We had the US CPI data, which showed inflation came in much hotter than already anticipated. So the core CPI for May, it was expected at 0.5% month over month. Came in higher, and the year-over-year figure was 5.9%, and it came in 0.6% and 6% respectively. Right, now that is higher than the consensus. That's the core CPI. It removes some of the seasonalities part to it. Right, so energy and food. Right, the headline CPI data consensus was at 0.7% month over month, and it came in at 8.3% year over year. And that's, and the new data that's come in, so that was the previous 0.7%, 8.3%. But now we had a jump on the month-on-month figure came in at 1%, and for the year, we're looking at 8.6%. If we're looking at year-over-year figure, 8.6% for May. Okay. Now, this combined with the consumer sentiment reading, which came out in an inverse way, right? So very negative, has led to a lot of pessimism in the markets. We're going to touch on that in a while. So, okay. So those are the sort of 2 key elements that came in from last week. So we have the ECB, the inflation data, and negative consumer reports, right? Those 3 sort of elements led to panic in the market. So markets are now expecting a more aggressive risk-off stance across the financial assets, right? So we're expecting central bankers to be a little bit more prominent in their rhetoric and more hawkish than anticipated, purely to tame inflation levels. Now that's going to have a negative, a risk-off effect in financial asset classes, as we've seen in the session today so far. So central bankers are fighting inflation and are unlikely to come to the rescue of the markets as we reach bear market technically, right? So markets are back to those prior lows, back to those bear market territories, okay? And with this ongoing recession fear at its highest level, right, it's unlikely that we're going to see the Fed put come into place. You can almost say the Fed put is likely to be kaput, right? It's at an end, even though we've seen it impacted in the markets a number of years now. I don't think that the Fed are now likely to focus on, rescuing the economy. They're now entirely focused on inflation, and I'll tell you why later on, right? So we'll touch on that. So why the Fed put is no longer in place. Okay. Now, sort of another sort of two components to sort of highlight there out of the five. Mostly focus on the week ahead. So we talked about three elements so far. So we spoke about two elements in regards to macroeconomic data from last week, which is the ECB, ECB rate decision, inflation report, and the consumer sentiment. We spoke about how that's led to a risk-off sentiment right now, as we're seeing sort of the Fed put is no longer in place. We see markets correct back to sort of risk-off scenarios. In addition to that, the week ahead, what are we focusing on? The focus there is central banks. So central banks are likely to be in focus, okay? Now, with central banks, there are three key central banks that I'm going to be paying attention to, more than one of them, right? So the first is, of course, the Federal Reserve. The Federal Reserve, Wednesday, 7 p.m. and 7:30, respectively, between sort of the interest rate decision and the conference, the presser. That's taking place UK time, right? So we're expecting that's going to be the most anticipated for the week ahead. Then we have the Bank of Japan. We do have the Bank of Japan. The Bank of Japan is on a Friday. It's on Friday. But again, I may touch on that in regards to what's happening with the yen. But in regards to their stance, their monetary policy stance, they've not diverged from their rhetoric in any of these most recent meetings, right? So we're expecting them to maintain an accommodative stance, and that is diverging against all other central banks. Okay, now that may change based on the yen weakness that we're seeing so far, but we'll cover that in a little while. Now, the third central bank is, of course, the Bank of England. The Bank of England is likely to raise rates. That is what it is forecasted at the moment. I'll probably bring up the calendar in a minute or so, but that's taking place on Thursday. That's taking place on Thursday. Now, the likelihood of them raising rates has been reduced now. It has been reduced, and that's because of the data that's come in this morning. Okay. Now, the fifth element to sort of what I'm going to be discussing as well, the five key points there, is macroeconomic data. Incoming macroeconomic data is pivotal to really manage how you go about trading the markets from a day-to-day basis. We're seeing sort of risk-off scenarios taking place, and already this morning we had UK GDP data, which came out worse than expected, and that's led to sort of a lot of sterling pressure, a lot of pressure on sterling moving lower. So there are other data that you need to be aware of. Most importantly, I'll probably indicate China and US retail sales coming out on Wednesday. Those are the two that I'll be focusing on. We also have, obviously, as I mentioned already, UK data, GDP data coming out this morning. I'll go through the economic calendar and what's taking place there. But tomorrow Tuesday, we do have employment report from the UK as well. So we have employment data coming out on Tuesday. So those are sort of the key elements to what I'm looking to discuss for the week ahead. Now, let me just remove this for the time being. The bear market continues. I'll come over to sort of the equity markets in a minute or so, but I mean, just looking at from a holistic standpoint, right? So if we just look at sort of these four equities here, I might just zoom in, just come in sort of where you can see sort of most recent price action movement. Okay, right, there we are. So you can quite clearly see how there's been a lot of selling pressure from Friday's session. From Thursday and Friday's session, we've seen a lot of weakness in the equity markets. And these equity markets are now testing back to those prior lows. We're testing back to those prior lows. So equity markets are plunging, right? And as I've already mentioned, this is coming from Labour Department. The Labour Department reported that consumer inflation had soared at its fastest annual rate in more than 40 years. Now, this CPI came in hotter than expected once again in May. This was the 22nd time in the last 24 months that economists have undershot the inflation estimate. Now, take how you want to take that. That clearly shows that market economists, as well as, you can even say central bankers, are they behind the curve? So far, they've got it 22 times out of the 24 times wrong, okay? So they've undershot where inflation is at this moment. And that gives you sort of that view, right? Where the central bankers were in 2021, they were saying that inflation was transitory. It's likely to, dissipate. It's likely to, be reduced in some time. But then that's not been taken place as of yet, okay? So, economists and central bankers have been wrong. They've been proven wrong in the last 22 out of the 24 months in regards to the inflation estimates. So what was expected in the last week's Friday's sort of inflation report? Now, this is the most important part here, right? Markets were actually hoping to get some relief from the inflation report. They were looking at that inflation reading will come in line with the prior month, or it might have moved a little bit lower to give a more an indication that what the central banks are already doing is impacting inflation. And instead of that occurring, we actually saw it rise. Okay, we saw it rise. Now, the focus is, the energy prices and the food cost is what led to that move higher. So there is that. But again, you've got to go with what there are two sort of key elements here. We have the economic data that's being released, but then you also have market participants and what their guidance is, what they're forecasting in the markets, right? Now, the data can be released, it can be bullish or bearish. That doesn't mean markets can move bullish, bearish. What that means is we're going to actually review what market participants review that economic data, how they take that economic data. And that's how we're likely to see markets move higher or lower. So market participants' view is extremely important because the surprise factor is what leads to a bullish or bearish outcome, a surprise outcome, should we say. And naturally, as you could tell from Friday's session, that was a surprise to the markets, where most participants assumed that, okay, inflation is likely to come in line or might move a little bit lower, but no, it came in higher at a 40-year high. And most economists and central bankers were incorrect. And that's why we saw this risk-off move, a large selling pressure coming into the markets, okay? So I've already gone through the numbers. The key sort of number to be aware of is, of course, the 8.6% reports, the consumer, not the core, the consumer price index. It jumped 1% in May, and it recorded from the prior month, and it's reported year-over-year figure of 8.6%. Do I have a supporting image here? Let's bring that up. There we go. So US headline and core inflation both rose more than forecasted in May. Okay, so you can see sort of, the core CPI, not as much, right? The focus is most likely with the headline estimate, which previous was 8.3%, came in at 8.6%. Okay. Now, I do have I can also show you this as well. So let me just remove this out of the way. So generally there are four key measures that are used by the Fed, okay? We don't just look at just the CPI inflation number. There are other the four key metrics here, okay? It's better to take a broader picture over here, okay? So we can see sort of the core CPI, so the core CPI, it's coming out at 6%. No, it's tailed down. It's tailed down to 6.2%, sort of in this region over here, right? So it's 6 to 6.2%, right, in that region there. Now, looking at core PCE index, that has reduced. Okay, so that's moving in a downward trend. Okay, downward move, right? But whereas the PCE index, which also trended lower, 6.6 to 6.3%. Okay. Now, one of the key indicators used by the Federal Reserve is the PCE, report. Okay, so do note that they're likely to review this, right? As if they all moved higher, that might have been a very, very sort of a stance for them to take a hawkish stance. Okay, likely to take a hawkish stance in the upcoming meeting. There could be where now markets are pricing previously the percentage of the probability of a rate rise of 75 basis points was extremely slim. It was likely that there was going to be a 50 basis point rate hike, right, or 25 basis point rate hike. But now that's shifted, so it's not between 25 and 50%. It's now between 50 and 75%. Now the 75%, I'd say, is under 20% probability on the CME Fed tool. But hey, as the PCE has reduced and the core CPI, and you're looking at sort of the core PCE as well, all being reduced. It's just the headline CPI that came in hotter than anticipated, right? I don't see that they're likely to do a 75 basis point rate hike, even though that some individuals are forecasting that. It's likely that they may do another 50 basis point rate hike in the upcoming meeting. And you can see in this here when there were stimulus checks being applied. Okay, so you can see sort of stimulus checks, 3 stimulus checks being applied, sort of, over the course of 2020 through to 2021, and how that sort of has all that liquidity has led to sort of a rise in the inflation figures. Okay, right. So yeah, so we've covered what's happened. We've covered sort of, from Friday's session what's happened. Now let's cover, what to expect in Friday and Wednesday's Fed meeting. Okay, Wednesday's Fed meeting. Do I have? Yep, I can bring this up. Okay. Now, in last month's Federal Reserve meeting, so the FOMC, we call it. Yeah. Okay, so the Federal Open Market Committee. Yeah. So these members, the committee members, get together during the FOMC, and it's 2 years. A 2-day meeting that takes place before we find out what takes place is behind closed doors. Okay, so it's a blackout meeting. And what they decided was that they would hike the headline funds rate by 50 basis points. This is the biggest increase since May 2000. Okay, so May 2000, there's not been a 50 basis point rate hike by the Fed. Yeah. Chair Jay Powell also firmed up the Fed's quantitative tightening policy. Okay, so from QE, we're moving to a QT state. So they were seeking for the 3rd time to withdraw quantitative easing. This is an effort to both reduce their reliance on both the US economy and America's sort of financial markets upon cheap and easy money, and to rein the inflation by dampening demand. Okay, so the plan was to reduce QE by $47.5 billion a month in June, July, and August, and then step up the pace to $90 billion from September onwards. So the total Fed, at the moment, the total Fed assets stand at a record $8.9 trillion. There's a lot of work to be done there. Okay, so that's more than double where they were before the pandemic. Okay, so that's another sort of key point there, is that just shows how much liquidity is put into the system during the pandemic, right? So we've doubled since 2020, since March 2020. Okay, right, and if we look and we sort of take a sort of a review of the past. Okay, so if we look at the past, right? So the current sort of Fed assets stand at, sort of, as I mentioned, $8.9 trillion. That's more than double since the pandemic, and it's 10 times more what they were in 2007, 2009 Great Financial Crisis, right? Prior to attempts at a QT in 2013. Now, when that did take place in 2013. Right. So there's 2013, there's say taper tantrum that taken place, right? In 2018 and 2019, that ended in the face of that so-called taper tantrum, where equity markets sold off because of that concern of rate rises being aggressively put up, and we saw, what did the Fed do? They came to the rescue. That's known as the Fed put. The Fed put came sort of to the rescue at that point, right? And the economic slowdown and that pandemic, respectively. So it will sort of be intriguing to see what the Fed feels now. That's the sort of the key point I want to stress now, is what are the Fed likely to do? Because now we're seeing markets at these bear market territory, right? Are they concerned about the market, or are they more concerned about inflation, right? Right. So now this is where I sort of feel where we're likely. Now you can see how what markets had been previously priced in. So we're looking at the Fed dot plot. This is the Fed dot plot. That was what was expected, right? And now, we're looking at what markets pricing in today. This is what we're seeing, far more hawkish stance than what's been determined in the Fed dot plot. Okay, and this is what's already taken place, right? Sort of, this upshoot move here. Okay. Now, looking at sort of the coming back to the equity markets, and this is my view what's likely to be expected now. It's a conundrum, shall we say? Okay, the Federal Reserve's credibility is now pretty much on the line, right? As they've got it wrong so many times, right? We know that they've got it wrong in regards to it being transitory, right? We know that the economists have been wrong 22 out of 24 times in the prior months, right? And what to anticipate. Yeah. So, Federal Reserve's credibility is now on the line as investors start to question if the central bank, let me just add someone through, if the central bank can actually bring down inflation, right? Because even they did indicate that inflation is likely to be a little bit tamed down. It's likely to move sideways in the most recent projections. And that didn't occur in the most recent inflation report. We've also seen recently former Fed chair Janet Yellen had admitted that her 2021 message that inflation was transitory was off the mark as well. So this just reminds us that, this reminds us that the market is of risk. Okay, so there can be a lot of risk in the markets, and taking the words of central bankers may not always be the wise way, the right path. Okay, it's known as central bank policy error. So, are central bankers likely to make more errors going ahead or less errors? That is the question. Right? So, what they are facing is this scenario here. Right, it is the choice between raising rates, right, and slowing the economy. So that knock-on impact is going to slow down the economy down, onto one hand, shall we say. Already we've seen a large impact back to these corrective levels that could continue if we see a much more aggressive rate path, right? So, the issue there is, raising rates aggressively is going to slow down the economy and could potentially put us into a recession. Or are they going to bring in the Fed put? And what we see is that they're going to let inflation run away, and that would do damage in a different way. But, it will also lead to the same end result, but at a slower pace, right? At a slower pace. That is the sort of the key point here. So, it's more likely that they're going to be more concerned about inflation, that they are going to be concerned about economic activity, shall we say. Yeah. Okay, so what else can we use in regards to sort of, to pick up the sentiment in the markets? And that's where we look at consumer sentiment reports. Okay, one was stated by University of Michigan on the Friday session. So just bring that up. This is the University of Michigan consumer sentiment from 1978 through to 2022. Excuse me. So, there is now an inverse move if you look at inflation and consumer sentiment now, right? So inflation is moving to the upside, consumer sentiment is moving to the downside. And the most recent reading came in at record lows. Look at these record lows. It's lower than 2008, and even going back to 2000 even, 88, we're looking at sort of 78 levels, right? 1978 levels. Okay, so, it's dating back to 1970s, right? Let's just say that. So this means consumer sentiment is lower than it has been at any point during the last 40 years. So it's that inverse relationship with inflation that we're seeing now, right? This is the cost of living. All of these are really sort of impacting consumers now. The cost of living rising, rising food prices, rising energy prices, and other sort of commodities as well. It's all having a knock-on impact in sort of the consumer sentiment over here. Now, just to add to that, just to add some further context there were two reports that were released last week. One was from World Bank, and the other was from the IMF. So, the World Bank declared that the world economy is in danger. It is in danger, and it actually cut its growth estimates for the second time, right, in a row. So even if a global recession is averted, the pain of stagflation could persist for a number of years, stated by the World Bank. Right? The IMF said that while higher rates are needed to cool inflation, policymakers must take steps to protect the consumer market from the rise in the cost of living. Okay, so these are all sort of key concerns at the moment now. So you can see sort of, recession fears are in the background, and they're gaining voice. They're gaining an audience. They're gaining a larger voice. Okay, so we can sort of dial it back. We can dial it back, and we'll come over to let's what I might do is bring up the economic calendar. Before I sort of touch on some of these key points over here, what I also want to mention is, okay, so we know that if we come over to the ECB, what I might do is actually move this to the side and we look at the DAX. Okay, so you've got the DAX over here. Now, we know rates are surging globally due to inflation. Okay, inflation is the biggest concern for all central bankers globally, and rates are going to surge in line to tame sort of inflation, right? And that also concerns the ECB. So the ECB have just signaled an unexpected larger hike, right? So far up till sort of last week, there's been somewhere between dovish to neutral stance between by Christine Lagarde and some of the other policy makers. I might also want to share an image here. Just give me a moment. I do have something that I could potentially share with you guys here. I shared this part of our, there we go. Let's download this now. Let's open that. Okay. So I shared this last week prior to the meeting. So there is obviously some changes that needs to be made over here, but it just shows you where they were. Okay, so where they were previously. Okay, so let me just come over to the right section. Okay, so now this shows us prior to the meeting. Now this shows us prior to the meeting. We know that most of the ECB members had been somewhere between dovish to neutral at some stage, but there were definitely sort of a majority, or shall we say a minority, that has now led to a majority have become hawkish, and that includes Lagarde. Lagarde had been sort of in the middle ground, somewhere in between sort of neutral to sort of lightly sort of hawkish. Now we're seeing a big switch there. We're being a big switch there. They've moved to more the hawkish stance. Okay. Now, what was most important from the ECB from last week's meeting was not that they hike rates imminently. It was the fact that they give us that forward guidance that they're going to raise rates. By giving that sort of early indication that they're going to raise rates, market can quickly start to discount that information into price. And then we see sort of when that does occur, we don't see a surprise move, a large move occurring in the markets. Okay, so now that's what the central bankers are looking to do, is voice their forward guidance so that some of it can be priced in, so that when that does occur, you don't see exaggerated moves occurring. So that's what took place in last week's meeting. So, the ECB gave us a more hawkish view, and they give it forward guidance from what to expect going forward. Now, it is clear that central bankers are expected to be more on the extreme hawkish side now that we've seen sort of what came out from that meeting. Now the question is, what's going to take place going forward? So European equities continue to move lower, as we've seen with the DAX, right? And if you look at Euro stocks, now there is likely to be, and what they've revealed is that there's going to be a series of rate hikes, and that might scale up from September onwards. Okay, so we now know that they're going to reduce their stimulus measures, their quantitative easing measures. But in addition to that, the rate rises are likely to sort of scale up from September onwards if the outlook doesn't look improved better, right? So Christine Lagarde did mention they're going to base this on incoming information, incoming data. And now if the data continues to get out of control, they are likely to raise rates, and it could get more aggressive as we sort of see that incoming information. Yeah. So that was from the ECB. Looking at the euro is also selling off sort of in a negative trend there. Sterling is also sort of moving lower. But before I go into sterling, let's have a look at the yen. Okay, so we're looking at yen pairs, looking at dollar yen, testing the 135 handle. We've seen sterling yen fall. Okay, so we're seeing a lot of sterling weakness coming into play and some yen strength, even though against the dollar, we're seeing still dollar strength over the yen. Now, the Japanese yen has dropped to a 20-year low against the dollar, 20-year low against the dollar. And that's due to their divergence in how they're going about their monetary policy. Okay, so Bank of Japan is still maintaining accommodative stance. Now, do note that inflation in Japan is just crossed the 2% mark, right? And most central banks are looking to maintain inflation somewhere between, most state 2%. But there are some central bankers that state we want it to maintain within a range between 2 to 3%. So Bank of Japan, they have just crossed over the 2% mark. Now, is the question the concern about inflation? Not so much so. I don't believe the inflation is the big concern for them, but currency devaluation is a big concern. Okay, their currency weakness is certainly a big concern. So one of the sort of key points that they had implemented in their last few meetings was a yield curve control program. Okay, so what they wanted to do is maintain the yield somewhere between a specific range. Okay, and if it maintains that range, then it's fine. They don't mind what takes place. But as soon as we break out of the range, then that's going to be concerning the markets, and that is where we are right now. So what we've seen is that the bond yield has pushed up to the upper limit of that of the yield curve control program that the Bank of Japan has implied, which now leads for them to take a stance, take action. Right, one of the actions that have come through, they've responded by buying over 1 trillion yen of bonds. Okay, so they bought 1 trillion yen of bonds. Now the question is are they going to continue this? Are they going to continue this? Okay, so that's what we need to keep an eye on. Is you need to keep an eye on the news wire, right? So what's being released from the Bank of Japan in regards to how they see their currency. That's going to be very pivotal, especially for the yen. And if you're trading the Nikkei, right, there is going to be that correlation between the Nikkei as well. Yeah. Okay. Yeah, so some individuals have mentioned inflation is more important for the Fed. So yeah, thank you for sort of mentioning that. If you have any sort of questions, put it in the chat. If you have any questions, put it in the chat. Earnings this time are going to be, yeah, so certainly it is, isn't it? You see the knock-on impact, right? So macroeconomics then going to have that knock-on impact on microeconomics. But the question isn't that earning releases, right? Earning results are going to be negative, right? That's not what's going to drive markets lower. The focus is going to be on corporations and what they state in their earning reports, right? So if they give that guidance that, okay, we're not going to do as well as the prime months because of the rate hiking cycle that we're in, right? Then that may not have a larger sell-off in that particular corporation. Okay, so you've got to remember that there are many elements to it, right? It's not just positive, negative results that leads to a positive, negative, move. No, market participants already know this information, and they're going to reflect how these corporations are going to manage themselves in this rate hiking cycle that we're in. Yeah. Okay. Now, so we spoke about the yen. I do want to speak about the pound and what's taken place, what's come out this morning. But before we go into that, what I'll show you is some of the sort of other key elements here. The first thing is the VIX. The VIX is higher. Okay, so the VIX is pushing higher. It's above the 30 handle. It's above the 30 handle. The dollar index is pushing back to those highs again, right? We're not quite testing those prior highs. So this is what we've seen. A retracement testing back to sort of the lows around the 101 figure, 101.20 figure. Now we're pushing higher. We're coming back to test those prior highs. Okay, so just be mindful. The imminent breakout expected above the 105 handle in the dollar. Yes, I do. Do you see further dollar strength in the following weeks despite such a strong recent push? Yes, I do. I can see sort of dollar strength continuing, especially if we see that the Federal Reserve go on to raise rates by say 50 and 70, somewhere between 50 and 75 basis points. That takes place, even though I did mention, right? So this is the thing that I forecast that. I don't see that the dollar's going to break out. It might do a false breakthrough. It might range, go sideways, onto around the 105 handle, right? But the breakout is going to come after the Fed meeting. And as I mentioned, the PCE index is a very important gauge for the Fed. Now, those are downtrending. So this, those inflation readings. So it's not just the CPI data alone. So what if the Federal Reserve come in at 0.25% of a rate hike? That's less than the market forecasted, and therefore we might see some dollar pullback in that case, right? Some equity strength, and it's that balance that we've got to maintain. And that can only be suggested once we hear more from the Fed. Yeah. So yeah, dollar strength coming through. It's going up to sort of test those prior highs. US 10-year sort of back at those highs again. So those previous highs that sort of met there, right? So we've broken the downtrend line that's been in play for some time. So we've got this downtrend line in play. It's back up to sort of that resistance. Are we going to continue? Let's see how that goes. Now, something to mention here is what's the recession warning from the yields, right? So if you look at the 2s and the 10s, that can indicate a recession. That may happen now. We may see the 2s and the 10s invert today. Maybe tomorrow, if we continue to see the sell-off and this dollar strength coming through, that means that I'm getting a higher yield for a shorter-term bond than a longer-term bond, right? If that inversion takes place. There has been some inversion between the 3s and 5s and 3s and 7s and the 5s and 7s as well. So there are some inversion already taking place. And that is also an early recession indicator. Yeah. So yes, dollar strength coming through, yields moving higher. The VIX has moved higher back above the 30 handle. Dollar strength coming through. There is a little bit of euro strength, and that euro strength is coming through due to the impetus that the ECB left us with on Thursday, especially from Christine Lagarde, suggesting a greater rate hike guidance going forward. We've covered some of the key elements of it here. So we know about what's taking place with the ECB in regards to the euro. We're saying euro is strong, but not as strong as the dollar, should we say, right? So if we move down to sort of a lower time frame, let's refresh that there. A key focus for me, especially this week, is going to be sterling, and sort of a couple of elements here now. Now, if I bring the economic calendar, switch it to today, right? So today we had some UK results. We had some UK macroeconomic data results, right? Now, looking at the UK economy, and we're looking at the GDP, right? Gross domestic product. Okay, so this is an indication of growth, economic activity, right? So the UK economy shrunk in April for the second month in a row, right? And this is amid fears of a recession already, right? Some are suggesting that European markets could be in a recession earlier than the US, right? So some are even suggesting that European markets are already in a recession, right? So the gross domestic product declined by 0.3%. Let's bring this up, down by 0.3%. That's what we're seeing. Oh, I want to remove the 2020. Right, so you can see something a little bit more clearer there. Yeah, so down. So, we're seeing sort of already two negative results here. We're seeing two sort of negative results here, right? So down by 0.3% in April. This is followed by that 0.1% drop in March. According to these figures, this is published by the Office of National Statistics. Now, the drop was fueled by a significant reduction in NHS test and trace activity. Okay, there is that suggested by, and that was released by a report by ING. Okay. In addition to that, this is not the only concern there. Okay, so even though we've seen a reduction in NHS test and trace activity, and that has now driven a decrease of 5.6% in human health and social work, right? But look across the board. If you look across the board and you look at, say, services, right? If you look at services are also down. You look at industrial production, that's down. Manufacturing production, that's also down. So across the board, we're just seeing, services down by 0.3%, and is one of the major contributors to the fall in the GDP figure. Production fell by 0.6%, and construction is also down by 0.4%. So all of these key metrics, are showing quite a pessimistic view when it comes to the UK economy, right? And it seems that businesses are certainly struggling in the face of these rapidly increasing supply and labor costs. And in addition to that, then you've got consumers are being impacted by the cost of living as well. Right. So it is the first time, that all main sectors had contributed negatively to a monthly GDP estimate. And this is going back since sort of, January of 2021. So all of them are down since January of 2021. Right. So, now here is the sort of pivotal point here, right, which is ING sort of reported in this morning's newsletter. So the ending of this free COVID testing in March means that April's UK GDP figures look worse than they are right? So is it likely that we could see a rebound going forward because of that sort of, that calculation there? And at the same time, we have the UK government putting in some stimulus, right? So offering some packages that sort of can counter the cost of living as well by Rishi Sunak and his oil taxes to these corporations. But this is the conundrum that we're in. So the Bank of England, they'll be in focus more on how bad the consumer story is and could get in the coming months. That's their focus, right? But as I mentioned, they may be able to raise rates, right? They may be able to raise rates as those extra government support should help ensure against that consumer-led recession. Okay, so as long as there is no recession or consumer-led recession, and cost of living is removed by fiscal means, some monetary policy stance can be applied, as 25 basis point rate hike can be applied. So that is the question there. We're going to see a 25 basis point rate hike by the Bank of England on Thursday, right? But again, you've got to be taking this with a pinch of salt, really. You've got to tread water here at this point here. So looking at this week, as I mentioned, right? So the focus, okay, we've got PPI figure from the US Tuesday, but the focus, as I mentioned, could be the unemployment rate as we're leading into the Bank of England rate decision. Wednesday, we do have a team meetup, right? We have a networking event during the daytime, and thereafter we have the FOMC economic projections statement, rate decision, then the presser 30 minutes later. So 7 to 7:30 p.m. UK time, right? And then moving on to Thursday, we have the MPC, right? We have the MPC, Monetary Policy Committee members define their official bank rate vote and the official bank rate itself. As you can see, it's already pricing in a 25 basis point rate hike. And if you look at the path itself, that's the path that we've seen so far. There's been instrumental back-to-back 25 points gradual rate rises taking place since December of last year. Right. Moving on, we've got housing starts figure. Keep an eye on the housing starts figure, right? What we want to see is deterioration from construction, from housing, from some of these sort of key industries that could hinder economic growth. Okay. And then Friday, early morning, we've got the rate decision in the Bank of Japan. It's on here as medium impact and low impact. So again, it's up to you what you take away from it. For me, I'm not looking to trade around that because I'm not going to be up that early to be able to sort of trade that. But I will be sort of reading into it to outline, okay, what's their view on the currency, okay, on the yen, and whether their yield curve control, how's that coming into play as it's sort of met its upper barriers, upper limits. Yeah. And then at the end of the week, we do have Fed Chair Powell to also be speaking as well. We're looking at speeches from Fed, and MPC member Pill as well will be speaking. Yeah, so just keep an eye on speeches there. Let's just shift this away. Just give me a moment. Just move this out of the way. Okay, so we've looked at the VIX, we looked at the dollar index, we looked at sort of some of the sterling sort of currency, sterling sort of moving lower, a lot more selling pressure coming through there. Coming back over to gold. Okay. What a move on Friday, right? What a move on Friday. Gold certainly sort of moving to the upside. So, a lot of, you can clearly see when gold moves when there's panic, right? And Friday's session led to some panic. And that's why we saw a large move, a large bullish move where gold was testing sort of these lows around here with a bearish move and then a sort of almost a V-shaped formation taking place there, right? So a move trending lower, sort of testing around the 1840 handle, tested a new low, getting down to sort of the 1825 figure. So you can see sort of if you had a tight stop loss below these lows here, you would have been stopped out, spiked out, liquidations taking place, and then we had the recovery. During sort of high volatile markets, look to have a wider stop loss. So it would have hit your stop loss and then recovered and moved to the bullish side and went on to sort of test almost the 1880 handle. Didn't quite get to 1880. Yeah, so aim to look to take profits within round numbers. Look to take profits within round numbers, right? So it came back to sort of the resistance that I've had in place for some time now. I've got this resistance level in place. It came to test that level. It's now sort of driving a little bit lower. As you can see in today's, as we start the week ahead, we're just seeing a systemic sell-off across the board, taking place. right? But again, you got to look at the contributions between sort of, the dollar index and gold, right? So there's a correlation there, and you've got to be in focus. If you see dollar breaking out 105, we can see gold move lower. But if we're seeing a lot more panic setting into the market, we can see gold strength coming through, and also dollar strength may come into play. So remember, on an intraday level, you may see correlations inverse and then positive as well, right? So you may see positive and inverse correlation on an intraday level. Right, so switching over, let's have a look at oil as requested. Yeah, so now oil is certainly moving in an uptrend. It's certainly moving in an uptrend. But as I mentioned, today is more a systemic sell-off taking place, right? It's a bit of a fear panic taking place and profit being taken if you've been already in the oil market from the 110 levels or the 100 levels or 105 handles, right? So, what we're seeing now is just, a systemic move lower across all markets, almost hitting the reset button, hitting a reset button. And now markets are going to begin to price in what they expect to occur for the upcoming sessions, right? So markets have, went on to test the 124, should we say 124 handle, 124.50 handle. Since then, it's retraced back down to the 119 handle. It hasn't quite, it did close just below the 119 handle, but you can see already sort of holding still. It's holding still above sort of the 118 handle, which I've got this as a prior level of resistance. You can see some resistance, support, resistance, and now there's a lot of price action in between, but historically it's shown evidence that there could be a turning point in this region here, right? So anything above this can be still seen as bullish. It's still moving on an uptrend, but this may be that buying the dip opportunity if you think that commodity bull market is going to continue, right? Just be mindful of any OPEC related news that comes through when it comes to oil, right? And then finally, before we sort of end the session, look at that time as well. What have we seen in the cryptocurrency markets, right? So what have we seen in the cryptocurrency markets? Panic, chaos, as mentioned. Panic, chaos, sell-off, right? Sell-off, right? It's clear to say, and I've said this over and over again, right? Bitcoin is not an inflation hedge at this point, right? It's not regarded as an inflation hedge. People are not buying Bitcoin because they see it as an inflation hedge. They see it's, risk on features. It's risk on features. It's a high risk asset. It's a high risk asset that is likely to do very well in a risk on environment as more flows go into it, right? But in times of uncertainty, in times of panic, in times of when there's markets are looking to readjust their portfolio, they'll actually take some profits or take the money out of cryptocurrencies, go into a little bit more safety into whether it's, I'm not going to make any suggestions, but, that's what we're seeing at this moment. Now, we really are flushing out and hitting some liquidation levels. As you can see, it's a sharp move lower. Okay, so it broke through this prior lows, and we're sort of testing the 25 handle, and it's broke through the 25 handle. So now sort of testing the 24 handle. The question is, at what point are we going to stop? What you don't want to do is catch a falling knife now, guys. What you don't want to do is catch a falling knife. So wait for more information to come into play. Now, one of the maybe contributions to the cryptocurrency sell-off is Celsius. Celsius is it's a well-known firm. Most of you should be aware of Celsius, but they have stopped withdrawals and sending your crypto assets to another wallet. Okay, they've just stopped you from accessing your cryptocurrencies from their exchange, from their wallets, and that's caused a lot of fear and panic in the markets. That ideally, in the true nature of cryptocurrencies, you should be free to take your cryptocurrencies at any point, at any time. And that's obviously not the case with Celsius. Now, what is important is to also note the difference between a decentralized exchange and a centralized exchange. And that's the negative elements of a centralized exchange, right? As what we've seen with Celsius. They have control based on their terms and conditions that they've set, that you just clicked, you never read into the terms and conditions, that they could hold your funds and not allow you to withdraw those funds until they see fit, if there's extreme volatility in the markets. So Yeah, when you're allocating your cryptocurrencies and you're looking to sort of, diversify it across, different types of exchanges and wallets, make sure you understand the difference between decentralized exchanges and centralized exchanges. You know the difference between a hot wallet and a cold storage for your wallet as well. Okay, those are ways to minimize the risk that you have in the markets. Yeah, but okay, that could be sort of one of the fundamentals that came into play. But the vast majority that we're seeing, and especially sort of, I think that certainly helped the markets to move, certainly as we've seen in this downward trend, not even a downward trend, a sharp sell-off, a sharp crash that we're seeing to the downside in regards to this news around Celsius. But ultimately, that also is being impacted by across all asset classes. Okay, we're seeing across all asset classes this panic and fear taking place at this current moment. Now, whether Celsius is going to be bankrupt, I don't see that occurring. I don't see that occurring. They're they're quite a large institution, quite a large firm already, and they have a lot of holdings under their belt. Collateralized holdings as well. So yes, I don't see that's the case at this moment. But hey, like I said to you, I'm not your financial advisor, guys. Just as a disclaimer, this is not financial advice. Do your own research. Speak to a financial advisor who understands your financial circumstances at this moment. Right? This is purely market knowledge and market insight from an educational standpoint. But the likelihood of Celsius going into bankruptcy, I wouldn't say it's there is a chance, there is a slim chance, there is a slim possibility, right? I have read into certain reports where when there has been redemptions or withdrawals, rather than giving the actual based on what their holdings were, they've actually borrowed Bitcoin to pay off the withdrawals and the redemption that's been requested, right, and maintain the wallets that they've already had, right? So there is that question now. So if you do a little bit more deep diving, a bit more of a deep dive into this, why not allow them to redeem what they've put in? Let them redeem what they've put in, or withdraw at whatever stage in the past, even though you've blocked it now. But why would you borrow against that to pay them off so that you can maintain what you have already? So there is that one concern that I have about them. But again, is that enough of a trigger for them to go bankrupt? I don't know. Do your own research in regards to that. And one final point, one final area that I want to cover, we're almost coming up to an hour and I want to sort of end the session pretty much soon, is this is a quick overview of where markets are, right? I'm not sure if you can see this clearly. I might want to zoom in. Okay, there we go. Zoom out a little bit. Right, so this is where you can see sort of, so we know where interest rates are. We know where interest rates are, and you know where Japan is, okay? Look at where Japan is. Japan are clearly very accommodative where all other central bankers are, very hawkish, and they're red, right? So that's what we're seeing there. New Zealand is already at 2%. Switzerland at 0.75%. They've raised rates already, right? And they used to be sort of at 0% to negative. Europe are next in line to raise rates as they've given their hawkish guidance going forward. China at 3.7%, Canada at 1.5%, the UK at 1% expected this week, of 1.25%, Australia at 0.285%, and they're behind the curve in regards to, if you compare them to Kiwi, right? But they are aggressively raising rates. And the difference there is that they almost had a similar zero COVID policy, similar to China. So they had these, at the beginning of this year, in the first 3 months of this year, they had implemented a lot of restrictions and lockdown measures that hindered their rate path, but they're mostly out of that now. China, I'm aware of, that are going into some areas where they are going to further isolation or restrictions. Just be mindful of the ongoing news in regards to China, in regards to their zero COVID policy measures. So some regions have implemented restrictions again, even though they had indicated that they're going to come out of restrictions. So other areas to be mindful of, we've got this, geopolitical risk, obviously, with US US and China, right? We're seeing some aggressive rhetoric coming from US and China in regards to Taiwan. Okay, so listen to sort of ongoing information that comes through in regards to that. Is that likely to be another major concern similar to Russia and Ukraine? Okay, right. When you're looking at cryptocurrencies, ETH is down quite aggressively. It's down now close enough to 15, nearly 16%. Okay, we're down 15.93%. Bitcoin is down 12.32%. So we see a lot of selling pressure, a lot of fear coming in the crypto space at this current moment. ETH is down 51% there, as you can see from year to date. Or that's 52-week range. That's the 52-week range there. All equity markets are down. VIX is quite bullish. So that's clearly showing there's a lot of fear and panic in the markets. As I said, this is probably a day where we're seeing a systemic crash, systemic sell-off, Monday sell-off, Monday panics, as we sort of seen this happen a number of times over the last 6 months, over those 5 to 6 months. Equity-wise, we're seeing dollar strength. So a lot of the dollar-based currencies, dollar-based currencies are outperforming. Also, euro-based currencies as well, outperforming. The rest are all in the negative territory. Yep. Okay, that's it from me, guys. As I mentioned, we're seeing a lot of weakness, a lot of panic in the cryptocurrency space, but that's across the board in all major asset classes, as we've seen so far. The Red Sea that we're seeing across these markets here. Hopefully you've enjoyed this session. Feel free to reach out to us if you have any questions or make a comment in the video. And yeah, I'll see you on the next session. So Mondays, 11 a.m. is a live session. So see you there. If you have any questions, send me a DM or put a message in the comment section, and I'll speak to you soon. Take care. Bye-bye.